Throughout the past 5 years, CVS was trading at around $100 a share, but since then it plummeted by almost 50%, and over the past year the company is down by almost 20%. And so today we will figure out if CVS is currently trading undervalued near its 52-week low, and if buying it now will yield you great return in the near future. Now, first of all, I want to point out CVS's high dividend yield of 4.68% compared to its healthcare sector. They also have a low trading free cash flow payout ratio of only 26.69%, which leaves them with a lot of free cash flow after they pay out their dividend. Now, one thing I don't like about the company is the difference between their market cap and their enterprise value, which is essentially debt. Now, jumping straight to the 9-pillar analysis, we can see that the company gets a rating of 9 out of 9. They have been growing their revenue at a rate of 7.55% yearly, their net income has been growing at a rate of about 17% yearly, and their free cash flow has been increasing as well. Now, if we have a closer look at the free cash flow, we can see that in actuality, it has been increasing since 2019, and then since 2021, it was decreasing. And year over year, it decreased by another 83.77%, so it's actually sitting lower than in 2019. Now, even though the company has decreasing free cash flow, if we have a look at their price to free cash flow over the past 5 years, it is sitting at only 8.16. And if we have a closer look, we can see that currently it's sitting even lower at 6.93, which means that investors are paying about $7 for every single dollar of the company's free cash flow, which is much lower than what they would pay for the average company's free cash flow. And this shows us that even with the decreasing free cash flow, CVS would still be considered undervalued compared to the current free cash flow they generate. Now, the company has also been decreasing their shares outstanding, and their long-term liabilities over the 5-year free cash flow negative dividends is sitting at only 1.46, which means that they won't have any issues with paying off their long-term liabilities with the free cash flow they currently generate. Their profit margin is sitting above 10%, that is what we like to see, and they also have a low PE ratio of only 15.50, which again would hint that they are undervalued compared to their earnings. Now, regarding their consecutive growth, if we have a closer look, we can see that they actually increased their dividend by 10% in 22 and 23, but they haven't increased it at all in 20 and 21. So they do have dividend growth, but it isn't as consecutive. But now let's calculate the company's intrinsic value, first using the Graham's formula revised. And when we plug in a 5-year earnings growth estimate at 10.68% yearly, we get an intrinsic value of $116.97. Now, for the next valuation model, we take the free cash flow of the company and project a growth rate of 5.3% into the future. And plugging in our minimum wanted rate of return, we get an intrinsic value of $105.60. Now, when we compare CVS to 4 of its competitors, we get an intrinsic value of $115.40, which again is a lot higher than the current trading price. And finally, we want to value CVS compared to their dividend. We plug in a projected growth rate of 3.67%. As with the dividend growth, I do want to be a little more conservative, and we get an intrinsic value of $76.72. Now, finally, averaging out the 4 valuation models, we get an intrinsic value of $103.67, which is 85.83% higher than the current trading price of the company. Now, CVS isn't 100% perfect, as we saw they didn't increase their free cash flow over the past 6 years at all. They also do have a lot of debt, but the free cash flow they currently generate is enough to cover that debt. So as long as their free cash flow doesn't keep decreasing, it should all be fine. And I do believe that CVS will grow steadily and above the average rate, as they are currently quite a bit undervalued, as we can see. Now, if you did enjoy the video, make sure to leave a like and subscribe, as it really helps me out.